Now, let's try to spend some time to understand the derivatives market. Here we are talking on the very basic aspects of the world of derivatives. So we would be covering the introduction, two major places where the derivatives are traded, the exchanges and over the counter. So we'll try to understand what they are. Different kinds of derivative contracts, though in general we have four kinds of derivative contracts. One, the forwards, the futures, the options and swaps. So for time being, we will look out introducing only the first three of them, the forward, futures and options. And what is the kind of payoffs that are associated if I get into a forward contract or a future contract or option contract? What are the various payoffs I get at different points in time? Options are again divided into calls and puts, so we'll discuss about that. Then, how are these typical kind of instruments used by three major types of derivative traders? We'll talk about who a hedger is, who a speculator is, and an arbitrager, and how they are using derivative transactions. And finally, we would have a quick discussion about centralized counterparties, who are the concept which has actually emerged after the 2007-8 financial crisis, especially dealing with counterparty risk. We'll talk about it anyhow. Dealing with the counterparty risk more and more associated with the over-the-counter market. So we'll spend some time in terms of understanding that as well. But remember, this is an introductory session itself. Very basic concepts are what are covered as a part of this. Now, nowadays, at least in the last 40 years, we are observing that the world of derivatives, financial derivatives, remember this is not mathematical derivatives, they became very important in finance. Year over year, the market has been growing exponentially. And there are lots of products, as I have already mentioned, four major products, out of which futures and options are two products which are traded across the world on various exchanges. There are different kinds of exchanges which are trading derivative contracts. Just like a stock exchange, we have many of the stock exchanges itself, or we have dedicated exchanges for derivatives which are trading across the world. And similarly, there are many over-the-counter transactions which are more like the agreements between two parties, not an exchange or a marketplace. We are talking of agreement between the two parties, typically characterized as OTC transactions. We see that many financial institutions, fund managers, corporate treasurers, they are playing a very active role in the over-the-counter markets. And coming to innovation, we are seeing that now today derivatives are bundled with the bonds called as callable bonds, or we look at convertible bonds. All these have some level of derivatives being packaged into the bonds. So the scope of derivatives has widened now. Derivatives are very heavily used in the executive compensation, into the salaries. You might have heard of employee stock option plans. It's an option which is a derivative instrument. Now we are seeing derivatives which are packaged into the capital investment opportunities, whether to accept a project or not, whether when to get out of a project. We have something called real options. Even that is one more usage of derivatives to the capital investment space. Derivatives are used even to transfer risk from lenders to investors in the mortgage market. Different kinds of instruments being created. Securitization is a major tool which is helping, and on the top of that, various instruments are typically created. And size wise, today it's much bigger than the stock market, especially when I'm looking at from the perspective of underlying assets. Now, looking at all these things, it really is becoming inevitable for every one of us to understand the basic concept of derivatives. And we should be able to be more and more comfortable in terms of trading in derivatives. Whether we are a finance person or non-finance person, today derivatives are becoming one of the most important sources of investment. So understanding the concepts behind it will really help us. Just to understand a very basic concept, derivative is a financial instrument whose value depends on the value of other basic underlying variable. So I can create a derivative on a stock, or I can create a derivative on an index. I can create a derivative on a currency, a bond, right? We can think of any interest rate, a commodity. Literally, derivative can be created on the top of any of them. And the price of that derivative will purely be depending on the price of this underlying on which I have created the derivative. Today, not just the traditional, these all I call them as traditional derivative instruments. But today we are seeing very heavy active trading in much more advanced derivative instruments like credit derivatives. We have to understand them as we move further, but just giving you some kind of flavors. That's it. Electricity based derivatives, weather based derivatives, insurance derivatives. So today the derivatives market horizon and scope has expanded quite drastically, and that is what is creating one major necessity for all of us to understand and start mastering the world of derivatives. Now, the first and foremost thing to understand here, the two major markets in which the derivative instruments are traded. As I have already hinted, we have two. One is exchange traded derivative contracts, and the other one is over the counter derivative contracts. So when I'm talking about an exchange, we have exchanges like NYSE, or when it comes to India, we have a BSE, we have an NSE, National Stock Exchange. So we have different kinds of exchanges where individuals are trading standardized contracts. So when something is traded on an exchange, the contracts are more and more standardized because the volumes of the transaction have to be much higher. So whatever that particular contracts which have more and more demand and supply, those are the ones that are traditionally taken up by the exchange. So it generally standardizes the contracts in terms of the quantity, the quality, the size. On various grades, the exchange standardizes the contract. And out of the four different kinds of financial instruments, futures are traded on the exchange. 100% of the futures are traded on the exchange, and different types of options are traded. There are some options which are traded over the counter, but some kind of options are traded which are more and more traditional options. They are traded on the exchange itself. And the remaining, which are the forwards and swaps, these instruments, they are traded over the counter only. They are not traded on any of the exchanges. And in any kind of an exchange based transaction, the exchange and which entity of the exchange, we call it as a clearing house. So let's say here we are talking of a transaction that is going to happen between A and B. Now in a traditional derivative transaction, we talk about A wants to buy something from B, right? A wants to buy an asset from B, not now, but at a future date. That's a typical transaction. But the date will be specified today. The price at which it would be purchased will be specified today itself. Now, A is agreeing to buy something from B and B is agreeing to sell something from A. So that is an agreement, which is what we are calling as a derivative agreement. Now, when I am talking about an exchange traded, we see that A and B are facilitated by an exchange in the middle. So A will transact with the exchange, A will buy from the exchange, and B will sell to the exchange. So B will sell to, so exchange will buy from B and sell to A. A will buy from the exchange. So it's like a middle intermediary that is standing between the two traders, and it is managing the risk. Now, because this is a future transaction, the buying and selling is going to happen at a future date. The payment for the same, the price is decided today, but the payment is not happening today. So the payment, because it happens at a future date, there is a possibility that either A may not pay at a future date and may default, or A may pay to B and B may not deliver the asset. Even that is a default. Now that is what we are calling as the risk. And by bringing a clearing house as an intermediary, the exchange is making sure that both the parties are protected from the risk of the other one defaulting. And in this process, the exchange is making both of them deposit some funds as a kind of a caution deposit, which is what we call as the margin. Just to make sure that one party is not suffering because of the default of the other party, exchange is asking both the parties to typically deposit some fund which is called as a margin. Now, by getting into this kind of a contract, the traders are very, very relieved of the risk, right? Just by depositing some margin, they are relieved of a bigger risk. They really don't need to bother about the credit worthiness of the other party with whom they are trading with. That is one significant element of any trade that is happening through exchange. But if it is over the counter, it's direct. It's a trade or it's a negotiation between two parties A and B. It's the same. Again, in any derivative, we talk about buying and selling something at a future date for a price, date, everything decided today. But the only thing is, in an over-the-counter market, it is A and B are dealing directly, whereas in an exchange traded, there is some intermediary who is facilitating the process. Now, there are two ways in which an exchange traded system works. Very old, in the older version of it is an open outcry system, where there is, okay, this is the physical exchange market location. All the traders, they come and meet here. This is a physical location. All traders come and meet on the floor of the exchange. They start shouting, they want to buy at this price, they want to sell at this price. So whatever the price they want to buy, whatever the price they want to sell, they'll keep shouting. And there are a set of hand signals. And based on those kind of signals, they indicate whether they are going to buy it, close the trade, or exit the trade. So that kind of a process is open outcry. Nowadays, with the advent of technology and a lot of advancements happening in the technology, Nowadays, this mechanism is becoming less and less used across all the exchanges. And slowly, all the exchanges are moving towards an electronic trading mechanism wherein whatever is the price at which the buyer or the seller wants to get into the contract, they are just entering it on the computer using a keyboard. And the system is actually doing the matching of the buying and buyers and the sellers. It's not the physical on the floor of the exchange, they meet and then use some kind of a gesture to say that their order is settled. Rather than that, the buyers and the sellers are entering their deals on the system and an electronic matching of the orders is happening. And this kind of technology has really resulted in the growth of another world of trading called high frequency or algorithmic trading, which is more like without the intervention of the human being, we are the computers, using the computers, we are able to initiate the trade. So I can send buy signals, sell signals to the system using a set of programs, using set of logics, algorithms, and more number of trades being sent. So the process has resulted in a quite a different world of trading altogether, and the electronic trading system has facilitated this kind of growth and development in the trading mechanism. But when it comes to the over the counter, okay, as I have already said, the forwards, which are the derivative instruments, swaps, and to a great extent, different kinds of options, non-traditional options, which are otherwise called as exotic options. These are all traded only over the counter. None of these products are traded on the exchange. Over the counter is always between two parties. So because the transaction is always between two parties, it is always customized. It can be negotiated between the two parties. There is no need of any kind of a standardization in the contract in terms of quantity, quality, etc. So in this kind of a market, we see banks, large financial institutions, investment banks, fund managers, corporations, they are all major players in this market. Now, this is where nowadays, after the 2007 financial crisis, where it was strongly believed that OTC derivatives have really contributed a great deal to the crisis. Following that, wherever let's say two parties are getting into a over-the-counter derivative contract, it is specified that either both of them, once the trade is agreed between both the parties, they can either clear this bilaterally, means on a mutual agreement between both of them, or they can use the support of a CCP, central counterparty. Means there is someone, some other, let's say a large bank or a large investment bank or any other intermediary, which acts as an intermediary to this particular trade. The settlement is done, so the payment is taken from here to here, and the asset is taken from here to here. The payment is given to B and the asset is delivered to A. So this is the typical central counterparty. Now even if C is coming into picture, now if A and C are getting into some other contract, the same logic can go. The same party, which is a central counterparty, can even interact with C as well. So this kind of mechanism where A need not have a separate contract with C again, C need not have a separate contract with B. So this is a typical bilateral mechanism where each one is having a separate settlement agreement with the other, with each other. Whereas in a central, Once the trade is agreed, the two parties are presenting it to a central counterparty, or in case bilateral, they are signing an agreement. Right? In case of a bilateral, only these two are there, no central coming into picture. So these two sign an agreement covering all the transactions. This has become more and more mandatory. Now, which talk about when can they terminate, what are the rules, should they continue until the last, or when should they terminate the transaction, especially if one of them is defaulting or something. What are the rules with respect to the termination of the contract? Then how the amounts are settled once the contract between them is terminated. How is the payment done from one party to the other? And just as a matter of protection against the default of the other party, how much amount of collateral needs to be taken by each other? All these things are typically calculated and mentioned as a part of the agreement, even though the agreement is bilateral. This is purely to make sure that the other party, even if they default, the party, the other party will not typically lose out. So all these things are clearly documented as a part of ISDA Master Agreement. International Swaps and Derivatives Association agreement. The transactions are very clearly documented. Now, the typical way the OTC contract is executed is the participants contact each other directly by the phone or email, so you don't need a physical presence at all. And most of the cases, especially for the most common standard contracts, standard forward contracts or swap contracts, we see that the banks are acting as a market maker. So when we are talking about a market maker, one of the parties is the bank. Probably if I am talking about something like this, A and B, let's say, want to enter into a forward contract. Now, it's very difficult for A to find B. Now, for that, A will approach C, which is a bank, mentioning its intent. Now, C is ready. If A wants to sell, C is ready to give a buy price. Similarly, if B wants to buy, C is ready to give a sell price. So, in this case, we are calling C is acting as a market maker. It is ready to give a buy price, which is a bid, or it can even offer, it can always provide a sell price, which is an offer price. And for the bank, the bid offer spread is a kind of income to the bank. Right? It will take the responsibility of getting the counterparties, and at the same time the commission that it takes for making this trade execute is in the form of bid offer spread. And what we really need to understand is, before the credit crisis, the OTC derivatives market was very heavily unregulated. Now a lot of regulations started coming in place, where the transparency of OTC markets was improved. As we have seen, the central counterparties have come up, the collateral requirements and all which need to be posted against the possible default, even those are becoming more and more clear and transparent. So the intention of the regulation is to improve the market efficiency and reduce overall systemic collapse, which is what has happened during the 2007-8 financial crisis. So this is the basic understanding of the over-the-counter market, and how I differentiate an exchange-traded market from the over-the-counter market. And after the crisis, as we have very clearly seen, there's a lot of standardization, there's a lot of regulation. Probably let me not call it standardization. There's a lot of regulation that has come out with respect to the over-the-counter contracts, especially the standardized When I say standardized over the counter, very typical, very traditional, like interest rate swaps, forward rate agreements, right? There are a few such instruments which are very common. Commodity forwards, foreign exchange forwards. So there are some kind of instruments which are more and more traditional in nature, standardized in nature. They are traded on swap execution facilities, which are more like virtual exchanges itself. All the participants can post both their bid and offer quotes, the prices at which they want to buy as well as the price at which they want to sell. And based on the quotes of the other market participants, I can look at whether I can buy or sell, which means it is becoming more and more similar to that of an exchange. And for settling, the regulations are clearly talking about use a central counterparty. Of course, there are some limitations and drawbacks of having a central counterparty as well, but there is a requirement that is coming out across the world that rather than doing a bilateral clearing, it's better to rely on a centralized counterparty for settlement of the various derivative transactions. And more importantly, whatever the derivative instrument, whatever the OTC trades that are being entered into, they have to be reported to a central registry. That's one more requirement that has come in the wake up of the financial crisis. Right? Now, another important thing that we really need to understand is in comparison with the stock market, we see that the derivative market, both over the counter as well as exchange traded, they are very huge. But one significant difference is in the OTC markets, the average size of the transaction is much greater, even though the number of transactions that happen on the OTC is much lesser. So each transaction is a very high value transaction that happens. Whereas when we talk about the exchange traded, there will be large number of small value transactions because even individual participants, retailers like you and me can very well participate in the exchange traded derivatives market quite more in number. Now, as we have already talked about, there are four major kinds of derivative contracts, one being the forwards. This is what we are going to discuss right now. We have futures, we have options. Swaps will come across slightly at a later point in time. Now, any derivative for that matter, we talk about buying or selling an asset at a certain future time for a certain price which we are agreeing upon today. But this, if I have to contrast it with the spot market, even the buying and selling is happening today itself, immediate. Whereas in forward, it's just an agreement today that the buying or selling will happen at some future date. The price is also agreed upon today. And when it comes to the forward, yes, A and B are getting into a forward contract. A is agreeing to buy an asset from B at a later date, let's say 1 month later, for some $100. So this is the traditional forward agreement. And forwards are always over the counter. And generally these kind of trades are entered into by financial institutions, between the financial institutions or a financial institution and its clients. It's very common that at least one party to this transaction, either A or B, is a financial institution itself. The party which agrees to buy at a future date, we call it as a long position, right? So that party is going to buy the underlying at that specified price at a specified date. And the party which is going to sell it on that day, we are calling it as taking a short position. Out of the various kinds of underlying assets that could be there for the forward contract, the forward contracts on a foreign exchange are very, very popular. And they are used heavily to hedge foreign exchange risk. Fluctuations in the exchange rate that can occur over time. To mitigate that kind of a fluctuation in the exchange rate that can occur over time, we can think of using a forward contract on the currencies. Now, let's say this is the kind of a quotation that is available with a particular dealer. Now, a dealer is quoting a bid price and an offer price. This is, let's say, pound versus dollars. It says that in the spot market, £1 is available. See, okay, this person, let's say a bank, which is an intermediary or a dealer, that party agrees to buy £1 for $1.5541. £1 this party is willing to buy, which means you have to sell at $1.5541. But the same party is willing to sell the pound at $1.5545, which means $0.0004 per every pound is the spread that the bank is getting into in this particular transaction. Now, when we are talking about the forward, 1 month later, if you are thinking of selling a pound after 1 month, the bank is ready to buy it at 1.5538. If you are thinking of buying it after 1 month, the bank is ready to sell it at 1.5543. In that case, it is making a spread of 0.0005. The same way, if you are planning to sell it after 3 months, bank is willing to buy it at $1.5533 a pound. And if you are going to buy it, bank is willing to sell it at $1.5538 a pound. Now that is what it means. Now let's say I have to pay, right? I'm a US resident, so my currency is dollars. But let's say after 3 months, I have to pay £100 to someone. I know that after 3 months, I have to pay £100. Now for me, the problem is, if the exchange rate, now today let's say the exchange rate is 1.5, I'll simplify this, right? $1.5 per pound. So because I have to pay £100, it would cost me $150 on that date, right, as of the today's price. But let's say if it becomes $1.6 per pound, now what could happen? I have to pay $160 on that day. So this is where I really want to buy £100. Buy £100 so that I can pay £100 directly. So I want to buy £100 in the forward market. Let's say in a 3-month forward market. If I have to buy, I'll look at the price at which the bank is offering to sell. I'm seeing that the bank is offering to sell it at 1.5538 for a 3-month forward. So I'll buy £100 by paying, let's say, 155.38. This is what I'm buying £100 for after 3 months. So after 3 months, I'll be paying $155.38 and I am getting £100. This £100, I'll directly deliver it to my vendor. Now, what is the deal here? Let's say on that day, the exchange rate has gone to 1.6. right? Exchange rate has gone to $1.6 per pound. So if at all I had not got into this forward contract, I would have ended up spending $160 towards the payment of 100 pounds. But now I am able to spend only $155.38 for that 100 pound. But the downside is, look at the other side. If the exchange rate had become $1.5 per pound on that day, then it would have been sufficient for me to pay $150 for that 100 pounds that I need to pay. But now, because of the forward contract where I have frozen the price, I am ending up paying 155.38. So in some cases it might be very much beneficial. In some cases, if the position is moving opposite to what I am expecting, it may give me an additional loss as well, right? So that's the way the typical forward contract works. And just to look at, I think we have discussed this example. So a treasurer of a US corporation knows that he has to pay this much in 6 months, and again the exchange rate movement is what he wants to hedge. So he will buy 1 million pounds. Now the 6 months one is available at 1.5532. So he would be buying 1 million pounds for this much. And so there is a long position that is created by the company, and the bank has got into a short position saying that it will sell 1 million pound after 6 months. Now if the spot rate has increased, then it would have been a benefit, right? Because I am buying it, I have bought it at $1.5532 per pound, but today it is $1.6 per pound. So I got, for every pound, I got a benefit of 0.0468, right? I got, for every dollar, I got a benefit of, for every pound, I got a benefit of this many dollars. Similarly, if it had gone the other way and fallen to 1.5, then for every pound I am losing 0.0532. So my value would be a negative 0.0532 for every pound. So in simple, if I have to look at, if I have gone into a long position, and from one unit of the forward contract, if I have to look at the payoff, it is ST minus K. The price, the market price on the maturity date, on the expiry date, minus the forward price, which we have agreed for buying and selling. So here, the market price, market exchange rate was 1.6, and the rate at which we have agreed to buy the pound was 1.5532. So the payoff is going to be 0.0468. The same logic, if the market price was market rate was 1.5, but we have agreed it at 1.5532. So again, the payoff to the long position is minus 0.0532. So whatever is the payoff to the long position, the opposite of it will be the payoff to the short. Whatever is the loss that has come to the long position will be the gain to the short position, and vice versa. So the payoffs can be positive or negative. Whatever is the positive to one party will be the negative to the other party, and vice versa in a two-party transaction. And one thing we have to really understand is it literally costs nothing to enter into a forward contract. So there is no cash flow or cash movement that is happening from one party to the other party. So a typical payoff diagram looks like this. This is for a long position. This is for a short position. If the market price, so this is where I am taking the market price on the expiry date or the maturity date, and K is what we are taking as the forward price, the contracted price at which the buying and selling will happen. So as long as the price is going more and more above the contract price, we see that the long position is gaining, and in that interval the short position is losing by the same amount. And if the market price is much below the K, then the long is losing, the short is gaining by the same amount. So this is how we look at these two are mirror reflections. Across the x-axis, whatever is the gain to one party is the loss to the other, and vice versa. Then, moving on to the futures, there is not much of a difference between a forward and a future. Even this is defined in the same way. It's an agreement between two parties to buy or sell an asset at a future date for a price which we are freezing upon today. The major difference being a forward contract is an over the counter contract. It happens on the OTC markets, whereas the futures is happening on an exchange. Major difference is this. Now, when it is OTC, probably we all know that it can be customized, it can be negotiated, whereas when the contract comes to exchange, it becomes more and more standardized. Right? But at the same time, because in OTC market there is a credit risk that is possible, counterparty risk that is possible, because there is always a fear in the minds of one of the parties that the other party may default on the transaction. Whereas here, the exchange or the clearing house that is present in the exchange, it takes utmost care to make sure that both the parties are adhering to the transaction. Right? It's only the mechanism that differs, but literally if we are looking at the kind of elements that are traded, kind of underlying assets that are traded even in the futures contract, we see wide range of commodities, financial assets. Again, when I say financial assets, the stocks, bonds, indices, right, currencies, we can talk about interest rates. So any of these are traded on different kinds of exchanges across the world. So again, the price wise, it is purely demand and supply based. The futures price is decided purely based on demand and supply. More number of buyers, less number of sellers. More long positions. Long is buy. Always try to link with that. More number of buyers and less number of sellers, the price will go up. More number of sellers, less number of buyers, the price is going to go down. Right? We will discuss about the futures contracts in more and more detail in the coming session, but just a quick understanding of the futures here. Then the next important instrument, options. Probably you can study volumes and volumes for this particular tool, for this particular instrument, because there is a lot of variety in the way this instrument is executed. Now this is this is the only instrument which is traded both on the exchange as well as over the counter. More traditional options are dealt on the exchanges, whereas more exotic options are dealt over the counter. And there are hundreds of varieties of options that are available. Here we are talking of two major kinds of option. See, if we had looked at the typical forward or a future, we said it's an agreement between the two parties. A will buy something from B, B will buy something from A at a future date. They are agreeing upon the price. Now, it is very much an obligation both for A as well as B to adhere to the contract. Whereas in the option, this is where a slight difference comes up. Out of these two parties, right, if I am saying A is a buyer and B is a seller, out of these two parties, any one of them can choose to back out of the contract. Legally, he can back out of the contract. It is not a default. If he wants, he can continue with the contract. Otherwise, he can exit out of the contract. Now, that is where the options play a very important role. If a buyer takes that kind of an option, we call it as a call option. If a seller takes that kind of an option, we call it as a put option. Right? Now, if the buyer wants that option, what does that mean? If he wants at a future date, it is purely his right to decide whether he wants to buy from B or not. It is not an obligation for him. It's a right. It's an option. If he wants to buy from B, he will buy, otherwise he will not. Right? The same logic. If B has taken an option, it means it's a right that he is taking, which will allow him to decide whether he wants to sell the product to A or not. If he wants to sell the product, he will do it, otherwise he will not. And if he really wants to sell it, it becomes an obligation for A to buy it. He can't back out. Only one party in one transaction, one party who has taken the option will have that right, whereas the other party is obligated to adhere to the transaction. Now, whosoever is the party who has taken the option, they have to pay a premium to the other party upfront. On the day of agreeing to the contract itself, there is some lump sum payment. There is called as a premium payment that is paid by one party to the other, whosoever has taken the option, to whosoever has given the option. Right? So that extra payment, it's a non-refundable, it's not a caution deposit, it's directly going to the other party. Now, whatever is the payout one party has done to the other, that's called as the premium. But by paying that premium, it is taking the right from the other party that if it wants, it can back out of the transaction as well. So if I quickly look at the call option, it gives the right to buy the underlying at a certain date for a certain price. Now it's entirely up to that taker of the option whether he wants to exercise this right or not. Similarly, when I'm talking about a put option, it gives the holder the right to sell at a certain date for a certain price. Now the price at which both of them are agreeing is typically called as the exercise price or the strike price. The date on which this buying or settlement will happen at a future date, it is called as an expiration date or maturity date. Now here in the traditional option space, we talk about two kinds of them. One are the American options, the other being the European. So whatever, okay, this is today and this is the maturity or the expiration date, right? If the person who has taken the option has to take a decision exactly on this date, on the maturity date, we are calling this as a European option, where the decision of going ahead or backing out can be taken only on the expiration date. Whereas when that decision can be taken at any point up to the expiration date, those kind of options where the decision of either exercising the option or expiring the option can be taken, those kind of options are called American. So again, American and European both can be applied to both call options as well as put option. And the major thing that is differentiating the options from forwards and futures is, in case of forwards and futures, on the day we are getting into an agreement, on the day zero when we are getting into an agreement, no money goes from one party to the other party. Probably there could be a there could be a margin that would be deposited with the exchange, which is like a security deposit. There could be a collateral which one party could be placing with the other party. But these are all purely security deposits. These are not the payment from one party to the other. When I'm saying payment, it's associated with the non-refundability of it. It's already a cost. Whereas in the security deposit case, it's not a cost. It's just to make sure that the other party will not default. So again, here when we look at the payoffs, we see four major scenarios. If I look at this kind of a scenario where, let's say this is the exercise price, right? And for time being, let's forget about the premium. Now when I'm talking of buyer of call, as long as the market price is less than the exercise price, the buyer will not buy it at X. He will expire the option. Only when the market price goes above the exercise price, he will buy that particular asset at the exercise price. Any buyer will buy at the cheaper. So if the market price is lesser than the exercise price, he will buy from the market, which means he will expire the call option. Otherwise, he will start exercising the call option, which means his payoff is going to be more like this. But if there is a premium, so let's say he might have already paid this much. He might have already paid this much as the premium to the other party. If that's the case, then his payoff is going to be something like this. Exactly on the parallel lines to the first one. So this is for a long call position. Now whatever is the position for the long call, I'll see it is more or less exactly equal and opposite in case of short call. Because whatever is the gain to the long is the loss to the short and vice versa. So this goes for a buyer of a call, this goes for a seller of a call. Now the same logic if I look at with respect to put options. So this is the right for a person to sell the asset at a future date. So if the market price is much above the strike price, he will not sell it at the strike price. He will sell it at the market price itself. So as long as the market price is above the strike, the person will not exercise the option. He will expire the option. But once the market price starts falling below the strike price, he will exercise the option, which means he will sell the asset at X. If the market price is much lesser than X, the difference is what is the payoff for him. Now even to get that, if he has taken some amount of if he had paid some amount of a premium, then obviously his payoff is going to be something parallel to this. And this is what is for a long put, the party who has taken the put option. The party who has given the put option will have exactly equal and opposite kind of payoffs that are happening. So this would be the typical payoff for a short put kind of an option. So any buying position we call as long position, sellers are called as short, and in some cases selling an option is also called as writing. So buy means I can talk about owning an option or holder of an option. But when I'm talking of sell, I'm talking about either a writer of an option. So this is a long position, this is a short position. So some of these terminologies I have to be very comfortable with. Now, the other aspect which we are getting in here, trying to understand different types of traders that are there in the derivatives market. There are broadly three kinds of traders whom we are going to look at, and there's a lot of liquidity in the market. Liquidity is referring to lot of buying and selling. Frequent buying and selling is very much possible in this market. So when any investor wants to take one side of the contract, it's not a difficulty to find a counterparty. There's a lot of buying and selling that happens in this derivatives market. So there is literally no difficulty in terms of tracing the counterparty for the trade. However, if I have to look at the different kinds of traders in this market, we are talking of hedgers. In the next slide, we will be looking at other parties, the speculators, as well as the arbitrageurs. So these are the three kinds of parties who are major players in the derivatives market. So the hedgers, they always use derivatives for risk reduction purpose. They already are exposed to some kind of a risk. Okay, I have bought an asset. So I have bought a share. I already own one share. Now for me, the risk of this is if the share price goes down in future, it's a loss for me. So I want to protect myself against this loss. And I'll be using the derivatives contract. Let's say I will sell futures for some price X, or I'll buy a put option for some exercise price X by paying some amount of premium to the other party. Now here my intention is I already have some kind of an asset, or I'm having some kind of a loss. There is a possibility of some kind of a loss on my existing scenarios, and I'm trying to protect myself from that particular loss. That is where a hedger is coming into picture. So the key purpose is reduce the risk. He is not interested in taking any kind of bettings. He is not interested in taking any kind of gamblings on the future movement of the stock prices or anything. He knows that he is already exposed to some kind of a risk. So to a large extent, he wants to mitigate the volatility or fluctuation of the price by locking the price or by getting into a deal where he is almost freezing up the price. So that's the reason I have to be very sure that there is no guarantee. In some cases, this could be profitable. In some cases, it may not be. But at the same time, I have to understand in both the cases, it's the volatility that is reduced drastically. I'm able to achieve consistency. I can very well predict how much is going to be my outcome much ahead. So I'm reducing uncertainty by getting into this kind of a contract. So the intention of the forward contracts or the intention of hedging purpose is always to neutralize the risk. It's not about making a profit. So when I'm talking about usage, I can either use forward or option. In case of forwards, I'm purely getting into the fixing of the price, whether it is for buying or selling. So I may get more than that, I may get less than that. But when it comes to using options for hedging purpose, they are purely like insurance, right? If things are not going well, they will protect. Adverse price movements occurring, they can protect. If the stock price is falling, I'll exercise the option and I'll get the protection. If the stock price is not falling, I will expire the option and I'll get a benefit from the favorable price movement itself. So that's the kind of difference that we can bring out by using a forward or an option for the typical derivatives transaction. And on the other side, we see a couple of other types of players or traders, speculators and arbitrageurs. Speculators are majorly, they use derivatives for betting purpose. So if they expect that the stock prices are going to go up in the future, they will take a long position in the derivatives today. If they expect that the stock price is going to fall in future, they take the short position in the derivatives today. So they are purely betting. There is no risk mitigation. They already are not exposed to any kind of risk. So those kind of roles are speculators, right? So this will really help. Then in the derivatives market, doing this kind of a speculation, it helps in obtaining leverage very heavily, because all they have to deposit is only the margin. So which is a very small percentage of the total contract value. So with a small amount of initial investment, they are able to trade in a very large position. So the speculative position could be a very large position just by depositing a very small amount of money. That is where derivatives are becoming a more and more leveraged position. If at all you gain, you will gain massively, and if at all you will lose drastically. Right? So that's the biggest advantage or drawback, both of them associated with the speculation transaction. So you will have the potential loss as well as potential gain, if especially if I'm going with futures, because they don't have the option to back out. You can't expire the option. In case of options, you can at least you have the right whether to go forward or back out. Whereas in futures, you don't. You have to adhere, which means there is a possibility that you will end up in a massive gain or a massive loss. But at least when we are going with option, probably if that party has got into an option which is for a long position in the option, at least the loss is minimized, loss is restricted only to the amount of premium that is paid to the other party. So that's one kind of a differentiation that we bring. Those are one kind of traders that are available. Then coming to the other side, arbitragers, these are the guys who play on both the sides. So they always take offsetting position. They always get into a long position as well as a short position. Long in one, the short in the other. So they always look out for mispricing in the securities. The securities which are mispriced, and they try to take the advantage of those mispricings and try to lock a riskless profit for themselves. But of course, if we are talking about a very small investor, the transaction costs are going to eliminate that kind of small opportunities, mispricing opportunities that are possible. Whereas when it comes to the large investment banks, yes, their transaction costs are much lesser because of the volumes in which they operate. And in those cases, they have very few transaction costs. But whatever it is, the mispricing opportunity will always be available for a very small interval of time, because everyone profit hungry. Everyone wants to take an advantage of this mispricing. So people just wait. The moment they are able to get an opportunity, they immediately exploit that opportunity. So the small opportunities are going to exist for small period of time, but arbitragers are those guys who specialize in trying to identify these kind of opportunities quite comfortably. So overall, we see these three major players in the derivatives market. And derivatives, they can be created almost out of any instrument, any underlying. They are more sophisticated. They are heavily versatile. They cater to the needs of large number of individuals. They cater for risk mitigation, hedging. They cater for directional betting, speculation, and there is a possibility of mispricing and taking an opportunity through arbitrage. So different kinds of players can enter into the derivatives market. So that much of versatility can cause problems. Sometimes there might be a mandate to go as a hedger or to follow an arbitrage strategy, but the person ends up executing as a speculator, whether knowingly or unknowingly. In those kind of cases, the whole strategy is getting lost out. So, and we have already discussed there is a huge amount of leverage that is there in derivatives transactions. So, if the controls are not there, just by paying a small amount, I am ready to take a large position. If I gain huge. If I lose huge. Now, to protect against that, the control should be very strong, which clearly send a message that the derivatives are being used only for their intended purpose. The limits need to be set, right? All the traders, what positions they are trading, everything has to be monitored on a regular basis. And probably we have to start reading through different kinds of case studies which talk about all kinds of failures that have happened in the last 20 to 25 years because of misuse of derivatives. So all those case studies will really help us in terms of understanding why derivatives are really a dangerous weapon. Is it really the derivatives are dangerous, or is it more the user did not know how to use it in a proper manner? Or is it the excess of greed that has created to these dangers? So once we read through those case studies, it becomes more and more evident, and it really gives a good value addition for us to really assess the goodness of the derivatives. And finally, the problems 2007 financial crisis, one of the major sources that was attributed to the failure was the OTC derivatives, right? So the OTC derivatives was growing and growing, and a lot of derivatives because of lot of transparency related issues, and because of lack of proper accounting mechanisms, they have gone into creating a viral effect in the economies across the world. That is what we called as systemic collapse. So post the crisis, Dodd-Frank Act came up. The intention is to reduce the systemic risk, one of the major intentions, especially with respect to over-the-counter derivatives. Now, some of the things that they brought out, at least the standard OTC contracts, they need to be cleared through a central counterparty. Just like the way in case of the exchange traded derivatives, there the central counterparty can charge a margin against the risk of default. So probably virtually it is looking like every CCP is like a dedicated futures exchange, even for non-futures transactions like swaps and options. Now whatever has been implemented in the United States now slowly is getting adopted to other countries as well. And by implementing this kind of centralized counterparties, we see that economies of scale can be worked out drastically, and counterparty risk can be reduced drastically. The risk of default of the counterparty can be reduced quite drastically. But of course, now CCP is again one entity. Every transaction is linked with the CCP. Now what if the CCP itself defaults? Right? What if the exchange defaults? In history, at least, the exchange did not default too much. There are no instances where exchanges have defaulted. But this central counterparty can go so big and it can go default. If it defaults, again, it is going to have a systemic concentration, and any failure of this central counterparty is going to be a catastrophic stuff. Now, but if there are more number of smaller CCPs, then the cost of dealing in derivatives is going to be higher, because no economies of scale will come. If there are more CCPs which are small, which have small businesses, then obviously the economies of scale is not going to turn up. So it's a kind of a balance that needs to be there, right? And but majorly, again, if there are multiple CCPs, is there a kind of coherence in terms of risk assessment methods across? Are there any kind of liquidity arrangements in case the CCPs are going illiquid? Is there any way to fund in the pumping in the funds? So all these things become challenges which are not yet addressed with respect to the central counterparties, right? But yes, in the wake up of the crisis of 2007-8, everyone started realizing that the OTC transaction settlement process need to improve, and the central counterparties is a result of that. All right. So just to look at on a broader note, we have summarized exchange traded contracts. We understood what is an over the counter contract. We looked at the payoffs of the forward, futures, call and put option, how the forward, futures and options are used by different kinds of traders, and toward the end discussed a little bit about the central counterparties, right? So this is what I wanted to cover as a part of the introduction to the derivatives module. All right.